Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley.
And I'm Seth Carpenter, Morgan Stanley's global chief economist.
And today on the podcast, we'll be discussing the Federal Reserve, whether its policy is behind the curve, and what's next. It's Thursday, August 29th at 2 p.m. in London.
And it's 9 a.m. in New York.
Seth, it's always great to talk to you, but that's especially true right now. The Federal Reserve has been front and center in the market's debate over the last month, and I think investors have honestly really gone back and forth about whether interest rates are in line or out of line with the economy. And I was hoping to cover a few big questions about Fed policy that have been coming up with our clients and how you think the Fed thinks about them. And I think this timing is also great because the Federal Reserve has recently had a major policy conference in Jackson Hole, Wyoming, where you often see the Fed talking about some of its longer term views, and we can get your latest takeaways from that.
Yeah, that sounds great, Andrew. Clearly, these are some of the key topics in markets right now.
Perfect. So let's dive right into it. I think one of the debates investors have been having, one of the uncertainties, is that the Fed has been describing the risk to their outlook as balanced between the risk to growth and risk to inflation. And yet, I think for investors, the view over the last month or two is these risks aren't balanced, that inflation seems well under control and is coming down rapidly, and yet growth looks kind of weak and might be more of a risk going forward. So why do you think the Fed has had this framing, and do you think this framing is still correct in the aftermath of Jackson Hole?
My personal view is that what we got out of Jackson Hole was not a watershed moment. It was not a change in view. It was an evolution, a continuation in how the Fed's been thinking about things. But let me unpack a few things here. First, markets tend to look at recent data and try to look forward, try to look around the corner, try to extrapolate what's going on. You know as well as I do that just a couple weeks ago, everyone in markets was wondering, are we already in recession or not? And now that view has come back. The Fed, in contrast, tends to be a bit more inertial in their thinking. Their thoughts evolve more slowly. They wait to collect more data before they have a view. So part of the difference in mindset between the Fed and markets is that difference in frequency with which updates are made. I'd say the other point that's critical here is the starting point. So the two risks to inflation, risks to growth. We remember the inflation data we were getting in Q1. That surprised us, it surprised the market, and it surprised the Fed to the upside. And the question really did have to come into the Fed's mind. Have we hit a patch where inflation's just stubbornly sticky to the upside and it's going to take a lot more cost to bring that inflation down? So those risks were clearly much bigger in the Fed's mind than what was going on with growth. Because coming out of last year and for the first half of this year, not only would the Fed have said that the U.S. economy is doing just fine, they would have said growth is actually too fast to be consistent with the long-run potential growth of the U.S. economy or reaching their 2% inflation target on a sustained basis. So as we got through this year, inflation data got better and better and better, and that risk diminished. Now, as you pointed out, the risk on growth started to rise a little bit. We went from clearly growing too fast by some metrics to now some questions. Are we softened so much that we're now in the sweet spot? Or is there a risk that we're slowing too much and going into recession? But that's the sense in which there's balance. We went from far higher risks on inflation. Those have come down to, much more nuanced risks on inflation and some rising risk from a really strong starting point on growth.
So, Seth, that kind of leads to my second question that we've been getting from investors, which is, some form of the following. Even if these risks between inflation and growth are balanced, isn't Fed policy very restrictive? The Fed funds rate is still relatively high relative to where the Fed thinks the rate will average over the long run. How do you think the Fed thinks about the restrictiveness of current policy, and how does that relate to what you expect going forward?
So first, and we've heard this from some of the Fed speakers, there's a range of views on how restrictive policy is, but I think all of them would say policy is at least to some degree restrictive right now. Some thinking it's very restrictive, some thinking only modestly. But when they talk about the restrictiveness of policy in the context of the balance of these risks, they're thinking about the risks not just where we are right now and where policy is right now, but given how they're thinking about the evolution of policy over the next year or two. And remember, they all think they're going to be cutting rates this year and all through next year. Then the question is, over that time horizon with policy easing, do we think the risks are still balanced? And I think that's the sense in which they're using the balance of risks. And so they do think policy is restrictive. They would also say that if policy weren't restrictive, there'd probably be higher risks to inflation because that's part of what's bringing inflation out of the system is the restrictive stance of policy. But as they ease policy over time, that is part of what is balancing the risks between the two.
And that actually leads nicely to the third question that we've been getting a lot of, which is, again, related to investor concerns that maybe policy is moving out of line with the economy. And that's some form of the following, that by even just staying on hold, by not doing anything, keeping the Fed funds rate constant, as inflation comes down, that rate becomes higher relative to inflation. The real policy rate rises. And so that represents more restrictive monetary policy at the very moment when some of the growth data seems to be decelerating, which would seem to be suboptimal. So do you think that's the Fed's intention? Do you think that's a fair framing of kind of the real policy rate and that it's getting more restrictive? And again, how do you think the Fed is thinking about those dynamics as they unfold?
I do think that's an important framing to think not just about the nominal level of interest rates, where the policy rate is itself, but that inflation adjusted rate, as you said, the real rate matters a lot. And inside the Fed as an institution, that's basically how most of the people there think about it as well. And further, I would say that very framing you put out about as inflation falls, will policy become more restrictive if no adjustment is made? We've heard over the past couple of years, Federal Reserve policymakers make exactly that same framing. So it's clearly a relevant question. It's clearly on point right now. My view, though, as an economist, is that what's more important than realized inflation, what prices have done over the past 12 months, what really matters is inflation expectations, right? Because if what we're trying to think about is how are businesses thinking about their cost of capital relative to the revenues they're going to get in the future, it's not about what inflation did in the past. It's what they expect in the future. And I have to say, from my perspective, inflation expectations have already fallen. So all of this passive tightening that you're describing, it's already baked in. It's already part of why, in my view, the economy is starting to slow down. So it's a relevant question, but I'm personally less convinced that the fall in inflation we've seen over the past couple of months is really doing that much to tighten the stance of policy.
So Seth, bringing this all together, both your answers to these questions that are at the forefront of investors' minds, what we heard at the Jackson Hole Policy Conference, and what we've heard from the latest FOMC minutes, what does Morgan Stanley Economics think the Fed's policy path going forward is going to be?
Yeah, so, it's funny. I always have to separate in my brain what I think should happen with policy, and that used to be my job. But now we're talking about what I think will happen with policy. And our view is the Fed's about to start cutting interest rates. The market believes that now. The Fed seems from their communication to believe that. We've got written down a path of 25 basis point reduction in the policy rate in September, in November, in December. So a string of these going all the way through to the middle of next year to really ease the stance of policy, to get away from being extremely restrictive to being, at best, only moderately restrictive, to try to extend this cycle. I will say, though, that if we're wrong and if the economy is a bit slower than we think, a 50 basis point cut has to be possible. And so let me turn the tables on you, Andrew, because we're expecting that string of 25 basis point cuts, but the market is pricing in about 100 basis points of cuts this year with only 3 meetings left. So that has to imply at least one of those meetings having a 50 basis point cut somewhere. So is that a good thing? Would the market see a 50 basis point cut as the Fed catching up from being behind the curve? Or would the market worry that a bigger cut implies a greater recession risk that could spook risk assets?
Yeah, Seth, I think that's a great question because it's also one where I think views across investors in the market genuinely diverge. So, I'll give you our view and others might have a different take. But I think what you have is a really interesting dynamic where kind of two things can be true. On the one hand, I think if you talk to 50 investors and ask them, would they rather for equities or credit have lower rates or higher rates, all else equal, I think probably 50 would tell you they would rather have lower rates. And yet, I think if you look back at history and you look at the periods where the Federal Reserve has been cutting rates the most and cutting most aggressively, those have been some of the worst environments for credit and equities in the modern era, things like 2001, 2008, kind of February of 2020. And I think the reason for that is that the economic backdrop while the Fed is cutting matters enormously for how the market interprets it. And so conditions where growth is weakening rapidly and the Fed is cutting a lot to respond to that are generally periods that the market does not like because they see the weaker data right now. They see the weakness that could affect earnings and credit quality immediately. And the help from those lower rates, because policy works with a lag, may not arrive for 6 or 9 or 12 months. It's a long time to wait for the cavalry. And so, the way that we think about that is that it's really, I think, the growth environment that is going to determine how markets view this rate cutting balance. And I think if we see better growth and somewhat fewer rate cuts, the base case that you and your team at Morgan Stanley Economics have, which is a bit of fewer cuts than the market, but growth holding up, which we think is a very good combination for credit. A scenario where growth is weaker than expected and the Fed cuts more aggressively, I think history would suggest that's more unfriendly and something we should be more worried about. So I do think the growth data remains extremely important here. I think that's what the market will focus most on. And I think it's a very much good is good regime. That, I think, is going to determine how the market views cuts. And fewer is fine as long as the data holds up.
That makes a lot of sense, Andrew. And thanks for letting me turn the tables on you and ask questions. And for the listeners, thank you for listening. If you enjoy this show, leave us a review wherever you listen to podcasts and share thoughts on the market with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.